Hi guys and welcome back to the channel. I hope everybody's doing good. To say January has had a shaky start to the year is a bit of an understatement. The S&P has come down over 5% this month alone, and if you're someone like myself who prefers to make strategic buys during these turbulent times, there are 3 stocks lined up here which I feel are good long-term buys. If you enjoy this video, please drop it a like and subscribe to the channel. Stock number 1 is the Walt Disney Company, an iconic company which has been around close to 100 years and will likely be around for the next 100. Disney of course own the Disney movie franchise alongside some of the best theme parks in the world and have been branching out by owning the likes of ESPN and ABC. They also own Marvel and Star Wars as well as many other studios and producers which are readily available on their streaming service Disney+, a full end-to-end interactive media behemoth with a multi-generational appeal. Revenue has been increasing most years up to 2020, where COVID forced Disney to close their theme parks for a sustained period of time. Disney counteracted this with the launch of Disney+, which greatly helped out in 2020 and 2021, and it can now catapult earnings with the expectations that Disney will reach $80 billion for year-end 2022. The exact same theme can be seen in the earnings per share, with the turnaround and recovery well underway. Disney does trade with a premium price to earnings ratio, with the share price right now sitting around $135 after coming down from nearly reaching $200 a share in 2021. Balance sheet looks solid with assets well outweighing liabilities 2-to-1, with net debt increasing from $16 billion in 2018 to $38 billion in 2021. Back in May 2020, Disney did cut their dividend, which has been progressively increasing since 2017 to save $1.6 billion worth of costs, but we still don't have any current signs of if and when this will be returning anytime soon. One of the other reasons for the share price reduction recently is that the market has been spooked by rival Netflix's subscriber miss in this month's quarterly results, which in turn nearly wiped out 25% of Netflix's market cap, giving them their biggest one-day loss since 2004. Now we've had a quick scan over some of the negatives. Disney has so many positive catalysts and none are greater than their portfolio of companies and film franchises. We've got Star Wars and Marvel as earlier mentioned, we've got the Muppets, Winnie the Pooh, and these type of franchises have stood the test of time with constant adaptations being rolled out every few years to reignite the spark with new audiences. The theme parks are the number 1 most visited attractions in the world, with 155 million people attending in 2019. Obviously these are the pre-COVID levels, and these figures are more than double the closest corporation, a real moat that separates Disney from the rest here. This quarter and year end has been a little step back to normality, with revenue increasing 3% to $67 billion, but also some really good results in the highlighted section, showing that Disney Plus subscribers has 179 million total subscriptions, which is a 60% year-over-year increase. Net income is also back to being positive from being negative in the same quarter last year. This $67 billion in revenue is materialised by $51 billion in their media and entertainment businesses and $16.5 billion through its parks. Pre-COVID, the parks revenue was about $24 billion, so there's still some way to go before these are back to pre-COVID levels. Disney Plus is expected to surpass Netflix in 2026, who currently hold the throne as being the leading streaming platform, with expectations that Disney will have a subscriber count of 284 million and Netflix to have about 270 million. Only time will tell in this projection, but the streaming war is well and truly underway. On tip ranks, we have an average price target of $195, which is close to 44% upside based on the average of 22 analysts, who have this down to 15 with a buy rating and 7 saying hold with no sell ratings. Stock number 2 is STOR Capital, who are a REIT that specialise in single tenant operational real estate, hence the name STOR. It's one of the fastest growing REITs, an impressive investment portfolio across the US. This company has often been given the title as being a swan company, sleep well at night, due to Warren Buffett backing this company. Constant, reliable, steady growth from just under 400 million in 2016, with gradual increases expected in revenue forecasts out to 2022, show that this is to surpass $800 million. Given more than 100% growth in 6 years for this steady Eddie, very vanilla company. And the funds from operation, which is the REIT equivalent metric in comparison to the earning per share, mirrors the revenue growth story, albeit to a slightly less percentage. The share price has cooled off a bit from 2021 and still got a good bit away from all-time highs in 2020, which was around $40 per share. Right now it sits around $31, offering a very appealing, close to 5% dividend yield to help ease some of this pain during this rocky time in the market. Balance sheet is in great health, with assets well outweighing liabilities more than 2-to-1, with net debt being pretty steady at around 3 to 3.5 billion. No company isn't without its drama, and in December, STOR Capital terminated Executive Chairman Christopher Walt without any cost, a very reputable character within the REIT industry who's built and sold a few successful REITs in his past and one of the co-founders of this company. One person isn't the reason to invest or not invest into a company, as it's a full team effort running successful businesses, but onto the fundamentals. 74% of customers have revenues of more than 50 million. The weighted average tenant revenues of 947 million, with 2020 tenant growth rate of more than 5%. Really strong underlying fundamentals for this company. They have a very diversified portfolio, and these are their top 10 customers, with the number 1 tenant representing only 3.1% and the top 10 making up 18.7% of their portfolio, which I really like here, as it means if even their top 1 or 2 customers close for business, STOR Capital's performance won't fall off the face of the earth due to the diversity that they've got through their customers. A pretty unique point about STOR Capital, and a very important one, is the length of the lease it signs. It's a leader in lease duration and gross returns in comparison to the majority of others, and has the least amount of leases due to expire within the next 5 years, offering an element of some safety. I touched on how I like the diversification, and to further emphasise this point, we can look through some of the various industries and groups that lease STOR's properties. Restaurants, early childhood education, car garages, pet care, movies, and the list goes on and on. And to view this as a very easy to read pie chart, all we have to do is look at the right hand side here, and this information is taken from their quarterly report, which confirms our point that they are a very evenly weighted portfolio. STOR Capital are a very strong, reliable company, offering growth and a high dividend. TipRanks has 8 analysts on this one, with 3 buy ratings, 5 hold ratings, giving us an average price target of $37, giving close to 25% return from current levels. And last on this month's pick, I've got Medtronic, who operate in the healthcare industry as an equipment provider. They develop, manufacture and distribute medical devices and therapies to hospitals, physicians, clinicians and patients worldwide, operating through 4 main segments, which are cardiovascular, neuroscience, medical surgical and diabetes operating unit. Really easy to understand business model, which should be around for some time to come, as their portfolio of devices range from everyday needs like surgical stapling in hospitals to the most advanced and innovative specialist devices around. Revenue's been pretty flat in the last few years, and even dropping into 2020 like most companies. However, growth from 28 billion to expected forecasts of 32 billion in 2023 make this a good slow to medium growth story as they try to get the business back on track. And the exact same can be said about the earnings per share, where it struggled the last few years, but even through these challenging times, Medtronic are still able to pay a very reasonably covered dividend. Although it's had a bit of a hiccup on the extract from Google, Medtronic does yield about 2.4% right now. The share price has come down over 22% from its all-time highs, making this quite a good buying opportunity in my opinion, although don't be fooled as it could go lower. Balance sheet, as with the other 2 companies, is solid, with 2:1 asset to liabilities ratio and debt remaining pretty flat over the last 4 years. Looking into their most recent quarterly report from November, it shows revenue grew 2.2%, with international growth offsetting subpar performance in the US due to the COVID surge. Cardiovascular grew 3.3%, medical surgicals up 0.3%, neuroscience up 3.1%, and diabetes up 1.4%, with earnings per share improving 29% year over year to $1.32. We can also see how revenue is broken down by segment and geography. Cardiovascular and neuroscience make up the vast majority of the revenue, with the US making up around 50% of its geographic revenue, followed by non-US developed and then lastly emerging markets. Growth in the US was down, but the huge jump in emerging markets is really promising, coming in at 16%, with 30% and 50% increases in Latin America and South Asia. Free cash flow of 2.4 billion is still some way off the target of the 80% target instituted in full year 19 results, so plenty of room of improvement here to get this business back on track. How do Medtronic allocate their capital? Well, they do this in a few ways. One is in the organic research and development into the company to enhance their pipeline. They also have minority investments of over 70 companies with more than 750 million invested. Dividend growth is high on their commitment to shareholders and has been growing this for 44 years, and are a member of the S&P 500 Dividend Aristocrats. It has 18 analysts this one, with 11 buy ratings, 7 hold and 0 sells, giving an average price target of around 25% from current levels, and that will make up this month's pick. I hope you've enjoyed this, guys. Got some value in it, and I'll catch you all in the next one.